flagship event for us for the year. I think the gentlemen on the dais do not need any introduction. However, we will start the curtain raiser with opening remarks by Mr. Sashi Jagdishan, MD and CEO, and Mr. Srinivasan Vaidyanathan, CFO of the bank. Thanks, and over to you, sir.
Morning to all of you. What a pleasure. I see a lot of familiar faces, and it's such a pleasure to meet some of you after such a long time. Thank you for coming over. There in a lot of the minds of yours and many other people of the world at large as to what is the rationale of the merger. Two is what do we see on the macro side? What do we see on even ex-mortgages? What is our kind of runway that we have? So let me try and cover some of these. I know some of you probably would have seen our presentation 2 days ago to the sell-side analysts, and I'm sure most of you would have either seen it or probably absorbed some portion of it. So sorry, this may be a repetition, but just indulge me in that. So the first is a lot of questions have been asked about India macro in my interactions with a lot of investors, both in India and even outside India over the last 20, 30 days. And our house view is slightly more optimistic, even of the situation that we are in from a macro perspective. I think if you really look at it, it's like carrying coals to Newcastle. You guys are probably much more aware of the macro than I do, but still my summary thought process, let me just express that. One is, I think the both between RBI and between the government, I think they have orchestrated it extremely well to ensure that there's a very gentle landing of the inflation situation. We peaked in April. I think with all the measures that we've taken both on the monetary policy now and what we are planning to do, where the governor has spelled out, say, at 3,500 basis points over the next 3-4 quarters, and the fiscal measures like dropping off the excise duties on some of the petroleum products, or clamping on some of the export duties so that we can have more on the domestic consumption side, reduce the input costs. I think we should sort of see the inflation go from May to September a bit and then glide down to the pre-COVID levels by March 23. This gives you a huge amount of a comfort as to where we stand as against where some of the other countries are. Typically, we sort of reference to the United States where the gap between the interest rates and inflation is too large. I think by March of 23, if the way the expectations are, I know there are a lot of assumptions in oil. I think if you go by what the experts have put in, I think it's roughly around the $100 at the moment. So obviously, all things remaining same, as long as the Ukraine-Russia war does not sort of deteriorate into something which is southwards, and that creates a bit of a crisis on both from a socio-political, geopolitical, and also from an oil perspective. If oil does not go to $150 and $175, I think we seem to be reasonably sanguine that our interest rate should not be more than 7,500 basis points. Our inflation should be going back to the pre-COVID levels around the 5.5%. Our growth rates should be around 7.2, 7.5%. This is a summary that we have from an in-house view. So we believe that when you compare this across the globe, we are probably one of the best economies, resilient enough to take on anyone else. We'll be the fastest growing economy. I know Mr. Diamond, I believe someone sent me what Jamie Dimon sort of spoke about it yesterday, where he feels there's a hurricane on the horizon. But that's his perspective when he looks at quantitative tightening and the gap between interest rates and inflation in US. And they have a rather bleak view of how the Ukraine war is likely to take shape. So as I said, that's the only risk factor that we need to factor it in. But I think India is reasonably resilient and they have balances very well from a multiple perspective, including having a forward contract with Russia in terms of the oil purchases. So from a macro perspective, I think we seem to be sanguine and we believe that we are probably at an inflection point in terms of where the country's economy is going to be. We are very bullish. A 3 trillion going to a 5 and a 7 trillion over the next 8 to 10 years is a distinct possibility. We will be the third largest economy, and therefore we are quite excited because as HDFC Bank, which is a play on the Indian economy, I think we are well positioned to ride on that kind of a growth. So this is, you will say that what is giving you that kind of confidence? Number one, you look at the per capita income itself. I mean, that's dramatically changed over the years. Today, on a purchase parity basis, I think we are at about, there it is in the slides, $7,000 plus. We probably are many more times as to what it was when US in 1982 was exploding. I think we are at that inflection point, so that gives a lot of excitement. Two, the kind of capital expenditure or the infrastructure spending that the government is likely to do, and you will probably hear it. I don't know whether Rakesh is going to talk about it or he has spoken about it in the sell side day. They are in regular engagement with the government across multiple sectors, and the theme of the government now is how to make projects bankable. That's a completely different thought process as against what was there in the past. And we believe in 8 to 10 months' time, this is what we are expecting. You will see a lot of projects getting unveiled that will only sort of carry the heft in terms of the growth into the future. The third aspect is the China Plus One strategy, the kind of, some of the groups that we have been engaging both from a company perspective and also from a personal perspective, where we believe that our large groups are going to be spending a huge amount of investments, whether it's in semiconductors, whether it's in chips in the solar cells, whether it's in batteries, whether it's in renewable, whether it's green hydrogen. And I know a lot of you probably are interacting with some of these groups and you probably have a better view of that, but this is from our own call reports and that's quite exciting about it. So these are, when you look at this is something that gave us the confidence that when we keep telling you that India is very underserved and underpenetrated for banking services. So we have a massive runway. We've been saying this for a long time. We're just about 11.5% of the system from an advances perspective. We believe that the runway is pretty long for us to continue the kind of growth that we have seen over the last 27 years. On top of it, we found an opportunity last year, and that is on the housing sector. Housing sector has been languishing for a long time, and you guys probably know this much more than I do. It is a sector which has been, which has a malaise due to its own creation, in terms of project delivery, in terms of the diversion funds. I think this was a fraternity which sort of had a lot of ills, I think which got corrected in many ways in the last 8 years. One of them is the RERA Act, which sort of, it's here, which sort of changed the ball game altogether. It brought in a huge amount of discipline into the sector. Two is the asset quality review which happened in 2014 for banks. And then post the ILFS and DHFL issue, the same asset quality review that happened for the NBFCs strangulated the funding to such an extent that only people with a financial discipline were able to get the funds. There could be outliers as we speak today, but largely I think this sector has come into a better shape than what it was 8 years ago. As we entered COVID, apart from couple of other sectors like capital markets where a lot of funds were sloshing, the bankers, the housing sector started to have a U-turn because the builders were forced to bring down the price by about 20-25%. You started to see sales, you started to see the inventory levels come down dramatically from a 50 month inventory to now a 25-30 month inventory. Also, I mean, when you look at the trends of affordability, when I say affordability, if you say on 100 rupee take-home pay, if the home loan EMI was about 50 odd percent approximately, say 8 years ago, now it's come down to 20-23% thanks to levels of increase in per capita, also the wage inflation over the last 8 years. So this is a massive change, and to sort of look at the behavioral change and the aspirational change that has happened over these years, thanks to telecommunication, internet, media, television, people have started to, even in smaller towns, are aspiring for better homes. So we started to see the aspiration levels go up, not just in the top 10, top 20 cities or towns. We also started to see a large portion of this in the smaller, the tier 3, tier 4, tier 5, tier 6, tier 7 cities as well. So and some of the macro strategists on the housing sector, and most of you know them, have estimated a demand of 2.5 billion square foot of housing space over the next 5 to 7 years. It's a massive amount of opportunity that's going to be there. It's going to be powering Indian economy. And with it, you will have the collateral benefits of steel and cement also getting powered with it. When Srini presented to us in May of 2021, it was compelling for me to look up, for all of us to say that, hey, it's an opportunity that we cannot miss. And then he juxtaposed this with a certain amount of data, which, whilst I may have unconsciously known it, I was a bit shocked. He said that, look, ultimately, we pride ourselves in our distribution heft with 6,000 plus branches, 70 million customer base. We are the largest retail asset bank in the country, ex mortgages. And when you come to the home loan distribution, we were probably X and your larger banks had a 3X. So that was something very puzzling. We didn't realize that, see, until now, we never sort of looked at it seriously. We had our plates full. Anyway, the sector was languishing, so we didn't have to really focus too much. And the home loan growth was not so bad as well. It was growing at about 24.5% compounded CAGR. So we did not it didn't strike us that there is an opportunity we are missing until he made this presentation to us. And that sort of made us think deeply to say that what is it that we're missing? I mean, why is it that we are not, our distribution and home loans is not as good or if not better than some of the other banks which had a smaller distribution? So we had to go down to peel the onion, go down to the front line to understand what is happening. Obviously, we always waxed our eloquence on the kind of arrangement that we had with HDFC Limited, where, and just to recap that, we said that we will distribute, because we did not want brand confusion in the market, we said that why create another home loan product? There is a company which has excelled in this product for 40 odd years. I mean, this was now going back to 2003, 20 odd years. Why would we want to duplicate that? We can sort of distribute their product and get a fee, and we can have an option to buy back. And it was a wonderful arrangement. I mean, on paper, it's a great arrangement, and we have no regrets about that. To buy back what we distribute, at least 70% of what we distribute back as a AAA securitized paper or a loan assignment, as the case may be, for which we pay an annuity through the life of the loan. Frankly, this is wonderful because the economics that we agreed upon was much better than setting it up. But then there was just one part of it, and we probably said that, okay, whilst we were setting up the bank, the retail bank, this is also one product offering, and you started to see a growth. As I mentioned, since this was something that never struck us because the sector was languishing for a long time, we went on with the flow. And we realized that, look, there's something which is missing in this kind of an environment, macro environment, where we are seeing a kind of a dramatic change, and we will see a dramatic change in the future. So when we went down to the ground level, we realized that, look, after all, it's an agency arrangement. This product is not our manufactured product. It is someone else's product. So the frontline staff had no visibility as to whether this particular customer who's going to come in with an application, whether he or she will be given a loan or not. Because all that we were doing is take the application, scan the documents, and send it to HDFC Limited. Now, the average turnaround time was about 8 to 10 days. And as you know, they had only about 600 branches as against our 6,000 branches. So branches which are far away from their hubs, the turnaround time was about 10 to 15 days. Now, obviously, you all know we have all bought home loans. We realized that, look, some of us who are loyalists will not mind maybe 8 to 10 days or 10 to 15 days. But in this world of an intense competition, it's an oligopoly market with an intense competition, it's 8 to 10 days is a long time, or 10 to 15 days is a long time. Obviously, we started to see people used to move on, and that's exactly what happened, because that's what gave me the second shocker. So he also presented the second set of numbers, which again surprised us negatively. He said that whilst we are theoretically open to sell home loans in about 6,000 odd branches, in reality only 1/3 of the branches are selling home loans, which sort of really puzzled. But I could now understand as we went deeper. And then he made another one saying that whilst you pride in terms of customer acquisition, we've been ramping up customer acquisition in the recent past. There's 70 million customer base. Only 2% have been sold a HDFC home loan. That was even a shocker when you compare with the kind of what shall I say, penetrations we have in other manufactured products. The reality is that the frontline people are youngsters. They are in the age of 23, 30. They are the large ones who are manning the branches. When they want to engage psychologically, when they want to engage with the customer, they need they will do only where they're very confident of. We have enabled the frontline team with tools like customer relationship management system, which have a lot of insights or the horoscope of a customer in front of them. With our vast analytics refined over a period of time, today we have the ability to tell what is the propensity of a product that a customer is going to take with the narrative, with the scripting, which is near personalized. We are still not there. We're working on that. I'm sure when you hear our tech and digital teams during the course of the day, you will see that what are the kind of partnerships we are doing with a lot of other great partners globally, like an Adobe and a lot of other people, in terms of getting even refined analytics into our stable. But that's the possibility that is there when you talk about our manufactured products. So today, if someone is searching the web for a new car, we have the ability to tell the customer, sir, I believe you're looking out for a car. We have an offer for you. You have a pre-approved sanction limit of 35 lakhs or 30 lakhs or 20 lakhs, as the case may be, and you can take it in 10 seconds. Whenever you decide. And we have, because we are one of the largest distributor of auto loans, we have a great relationship with, say, top 700 dealers across the country. We can arrange for a test drive. We can also have your existing car valued. We can exchange, and we'll give you a loan in 10 seconds. And that's a kind of a very powerful narrative when it comes to that. And that's all that stability that we have to our frontline staff. But when it came to home loans, we never had that because it's a different company. We never had the ability to know whether that particular customer is going to be sanctioned or not. So look at the confidence. The person, the youngster at the front end will never proactively sell a home loan because he doesn't want an egg on his face. Because what if that particular application gets rejected for anything? It may not be for credit, it could be for collateral, it may be for the builder. So these are some of the things that is ground reality, which we probably did not sort of go deeper because there was no necessity to do so until now. This was around May or June 2021, and therefore his crying, his saying was, look, I think there's an opportunity and we are going to miss an opportunity. The icing on the cake was when he presented the next data point. He said, whilst only 2% have taken a home loan, two things I will tell you. The 2% who have taken a home loan actually is giving you an average liability balance, which is 5 to 7 times more than a normal average customer. Now, that's massive because, and it's quite intuitive because a home loan customer, especially in a country like India, especially where they're going to be staying in that house, is very emotional to that particular person. He or she will ensure that balances are built so that the checks don't bounce or the EMIs don't bounce. It's a normal thought process. So naturally, one could figure out as to why the average balances were 5 to 7 times than that of a normal balance. But that's massive. That's an opportunity. Then he went on to the second data point, the last data point. He said, whilst you may think only 2% has penetrated with a HDFC home loan, there's a 5% which have taken home loans from a smattering of other banks. And that 5% is equivalent to another HDFC retail bank. And that made me sit with saying that, wow, whilst we have ceded control, we have ceded an opportunity, my mind was just racing to say that there's a massive opportunity waiting for us to be tapped. Now, so he ended the presentation with saying that here is an opportunity that we should not miss. So the first time I was kicking myself to say that, yes, how did we miss this? And obviously these things may be elementary, but it didn't sort of strike my mind. And this is the time that I took notice of this. There were two things that I could have done. Either we go back to HDFC management to say that how can we correct it, or I requested him, let's do one thing. I know that in 2014, we did a kind of, we developed a model to see whether we can see whether the merger makes economic sense. So he dusted off that model along with his team, and they worked on it. And I had reasonable confidence that it's going to be the same answer. No. Around October of 21, I think he came back and said that you'll be surprised. We would like to present something to you. And all the boxes that we said did not make sense now seem to make sense. So obviously we sort of deep dived and challenged ourselves on that to see what has changed and why is it different than what it was 8 years ago. Because let's face it, someone said the marriage was an obvious but not an obvious kind of subject matter. So for 20 years, all of you have been listening to this. We've all been, talking about this, and we've always said, we're always on the back foot saying that it doesn't make sense, or we're not ready, or the regulations have to change. This is it. So obviously in these 8 years, a lot of things have changed. Going back to 2014 when we last did this, HDFC approximately, if my memory serves right, had about a 300,000 crore balance sheet when we did the work at that time. I think 75,000 was non-retail and about 2.25 lakh crore was retail mortgages. The total 300,000 crore with a corresponding funding on with deposits and also with interbank loans and some bonds also there. But not so much on bonds, more on the interbank and more on bank borrowings and more on deposits. At 300,000 crore balance sheet approximately, the regulatory threshold for reserve requirement was around 27% or 26%. Just take 30 for simplicity. On a 33 lakh crore, it will be 90,000. So between 80 to 90,000 crore was the reserve requirements that one had to maintain if it becomes a bank, which meant that we had to raise incremental funding and then put it in government securities to the extent of about 80,000 crores then. That's part one. Part two was the same 300,000 crores on the asset side would be subjected to private sector. That at 40% of 33 lakh crores was 120,000 crores. There were certain exemptions of, which were there. So it came down to a further about 90,000 crores. So effectively, we had to raise incremental funding of about 150,000 crore and then put it in government securities and priority sector assets or rural infrastructure development bonds. So this is the ask. When you compare with that, the bank at that point in time had a capacity to raise 60 to 70,000 crores of liabilities per annum. That is all it had the capacity. So just imagine engine which is generating 60 to 70,000 crores. How do I do 150,000 crores, which is a tall order? Respectfully, I think all of us, both the leadership teams decided that we'll wait for further changes in regulations over a period of time. So that is how we buried the subject. After 8 years, a lot of things have changed. And that is where we were surprised. I think ever since the ILFS issue and the DHFL issue, I think the regulations on large NBFCs have undergone a series of changes. The first thing I think they realize is liquidity is so important for NBFCs after the ILFS crisis and the DHFL and during that period, how all of us, including you, looked at NBFCs, including our credit teams. We were all worried about their liquidity, etc. So what did the regulations do? I think they started to slap liquidity coverage ratio for the NBFCs, especially the large NBFCs, as a part of the convergence of large NBFCs into the banking norms. There were a lot of other changes in terms of the NPA recognition, in terms of the daily stamping as it's there behind. So HDFC Limited, always up the curve. 8 years ago, they had 4,000 crores of government securities. Now, when you look at it, they have a 40 to 50,000 crores on an average. Maybe later as we go into the future, it'll be more. But 40 to 50,000 crores of government securities in their books now. Since October of 2017, when we started to change track in terms of our philosophy on liquidity, we have been keeping excess liquidity reserves in the form of high quality liquid assets, including government securities. We also run about 30,000 crores on an average excess government securities over and above what we require. So when you look at the requirement today, one, the 26% has come down to 22%. So they have a liability today of, or at least in December, they had about 4.4 lakh crores, say 4.5 lakh crores, at 22%, less of exemptions. It came to about roughly 70 to 80,000 crores is the ask. Is it, here, 70,000 crores and CRR. So roughly about 85,000 crores. When you look at the excesses that we are holding, between 40, 50,000 crores or 20, 30,000 crores, the ask that is there now to raise incremental liabilities and put it in government securities comes down dramatically. It's just the balance is, who knows? I mean, our hunch, the way we are going, I think by the time the effective date happens, we may not need any incremental funding to put it there. So that's a massive change from what it was 8 years ago. Even on priority sector, there's been a wonderful innovation that has happened over the last 8 years called the priority sector lending certificates. It's a brilliant innovation where people with excess priority sector can sell for a fee, and people who are short can buy for a cost. These are all screen-based trading, so effectively you don't need any incremental funding to meet your directed lending requirements. The market is 600,000 crores today. It's growing at about 10 to 15%. So we have been patronizing this. We will continue to patronize this. Our estimates is that if the requirement is about whatever, 175,000 crores of priority sector, 50% of that can be achieved through the priority sector lending certificates for a cost, which hovers around 1.5%, 2%. And the balance, we will have to put it up in either RIDF or in priority sector assets, which means that we have to raise liabilities and then put it into that, which is the 80, 90,000 crores. Mind you, we have, when you look at the total priority sector requirements of 40%, that's just total. That's not a problem. None of the institutions, hardly few institutions would be not meeting that. Most of us meet it. Combination of our core organic priority sector, which is at a 3+% ROA, or we buy priority sector either in the form of interbank participation certificates from other banks, or priority sector certificates, the lending certificates that I just spoke about. So, this 80,000-90,000 crore is what we have 33 months from now to raise the incremental liabilities and start building this. When I say 33 months, how did you arrive at that? We believe the approval could take about 18 months, and then another 15 months, so 33 months to meet. Maybe December 24 is when we need to ensure that we have liabilities and put it in either RIDF or a part of it in priority sector funds. So that's reasonably long window that we have. We have a larger runway, so we believe we can sort of manage this without too much of an effort. So these two were a big change, where effectively from 150,000 crores of incremental liabilities to put it into various regulatory requirements for an engine which is doing 60 to 70,000 crores on a per annum basis, to moving to just 80 to 90,000 crores, where now the engine, which is the HDFC Bank engine, is doing a 200,000 crores of annual liabilities without too much of sweat, and that too at not its full capacity. When I say not at full capacity, you see the time deposit growth is just about 7%. We have said that we will manage our funding only to the extent that we require. So can we push the engine to do more? Absolutely, and that is one of our strategies. So the picture changed dramatically. The icing on the cake for us to really go on the front foot was on the pricing itself. HDFC Limited 8 years ago was priced at 6 times book. We were at 3.5 times. Now, after 8 years, which means that they were 1.3 times our share price. Now they are 0.8 times. They are 3.5 times book, 0.8 times that of HDFC Bank. It's here. So the purchase consideration has come down dramatically, which means that the clinching one is that we are going to take $40 billion of net assets. You know, there's going to be capital coming in, so the denominator is going to go up. We will see a depression in the ROE, the return on equity on day 0. However, within the 4 to 5 years, you are going back to the pre-merger ROE basis our natural growth rates, nothing extraordinary. This was a completely different picture as against what we saw 8 years ago, when we did not have the shorter horizon to see when we will get back the pre-merger ROE. This was the icing. So when you looked at the macro, which is screaming, saying that you don't correct yourself, you will miss out as a great opportunity, overlaying on your otherwise banking opportunity in the housing sector. 2 is the convergence of all the metrics which were not in favor 8 years ago is now there. So why not go and talk to them to say that why not? And that is how, for the first time in 25 years, we batter on the front foot saying that we need the merger. This was around November 21 or November 21. And I think they came back to us, or rather, we sat together under one roof in end of February, and we agreed that yes, it makes sense, and therefore we started to close this out as quickly as possible, which culminated in the 4th of April announcement. So what are we trying to see here? We are seeing that whilst we have a great runway in terms of the bank well positioned post-COVID, where we have navigated reasonably well during this 2-year period, We're now, all our segments are firing from all its sides in terms of growth. Yes, the clouds being only on the Ukraine-Russia impact and probably I hope we don't have a COVID-4, COVID-5, etc. Other than that, I think India's macro is going to be on a roll. We are a player in the Indian economy. We are well positioned for growth. We have a visibility of a 20, 30-year runway in terms of whatever we have been doing for 27 years, consistently growing. And then there is another macro overlay on the housing sector, which we believe will take us to a different level of growth. We can virtually have a durable growth in terms of better duration, in terms so that we don't catch our own tail every 18 to 24 months. We have a massive opportunity to see the ROAs going even beyond, because there's a cost of funds opportunity. The HDFC's cost of funds is about 580 basis points or so. We are at about 360 basis points, so there is a 220 basis point differential. Even if you were to shave off 120 basis points, just hypothetically speaking, which is not going to be the case, but hypothetically you want to put in more investments in terms of more credit officers, more distribution, and also in technology, or in raising more liabilities, because we will want to raise more, and that is a key factor. We are now looking at a product which is a 2+% ROA, which itself is very good, to a 3+% ROA. So it's going to be and when you multiply that, with even with a certain leverage of 9 or 10, it's a wonderful, 18 to 20% ROE business. So why not? So we will be virtually doubling a bank every 5 years when you look at it use your models without too much of sweat. We are not saying that we're going to be aggressive, but just the fact that here is a product which is a very emotional product, which is a very sticky product, and this is an easy product for our frontline to say, because it is very close to everyone's heart. So the narrative to a customer is going to be very good, and this is a franchise which is supposed to be the best in India. The opportunity to look at the multiple opportunities that's going to lead. Number one, as I mentioned to you, the liability franchise, which is a part and parcel of this cross-sell, is going to be 5 to 7 times more. So it's going to be, kind of a double advantage. Look at the third advantage. We are the largest consumer durable finance company outside of Bajaj Finance now. Whenever a customer wants a home loan, the opportunity to cross-sell a consumer durable is inherently very high. So the bundling opportunity with a home loan is something that will take us to the new level, whether it's new furniture, new kitchenette, new consumer durable. It's a massive cross-sell opportunity. And that also is a high ROA product. The last but not the least is the fact that today, in 27 years, our credit architecture has excelled in the unsecured bit. The unsecured lending on an overall basis, including corporate, SME, and retail, is about 35% of the total. I think from a retail perspective, it says about 41%. When you overlay that with housing, when it comes down into the total business mix, it comes down to 22%. Whether it's the leadership team, whether it's a regulator, whether it's the credit teams, or all of them, well, even though we have executed this very well, there's always this niggling doubt: are we having a high concentration on unsecured? It's natural. You will ask this. We ask ourselves. Our credit team keeps worrying. I mean, when you speak to Jimmy Tata, his ears become red when he talks about high concentration on unsecured. But anyway, this will give a huge amount of relief for all, saying that the runway is there. It's a high ROA, high ROE, and a low credit cost product. So we are proud of this. We Just imagine the kind of a multiplicative impact when you talk about just one product being put to the customer. So that is why we believe that here is a once in a lifetime opportunity to take the bank, which on the date of merger could be churning a $6 to $7 billion of profit on an annual basis, to go to a $14 to $15 billion in 5 years' time. That's the kind of massive growth that we're talking about. It's virtually going to double the bank every 5 years. Look at it. When you look at the product penetration, when you look at credit cards, our penetration is about 20%, in the 20s. Our unsecured loans is somewhere in the 13%. Vehicle loans is 6%, mortgage is less than 2%. Just by focusing on an emotional product, a product which is easy to sell because that's what every Indian wants, and the fact that we have a distribution which is not really harnessed, the taking a vision from a 2 to a 7 to a 12, because you add every 5%, which is what creating another HDFC bank is going to take the bank into a new level. So this is the reason why, the rational thought process behind this. We're quite excited. There are a lot of others you probably will be meeting, look at our distribution, etc. And one of the key limiting factors here, let me upfront tell you, is on the liabilities. Growth is going to be pouring out over years. And growth is something that is within our control, the asset growth. What is going to be limiting is our liability engine. So we have to have a strategy to ensure that we are able to absorb this kind of growth. We're now in 3,000 towns and 6,300 branches. The branch distribution has been in the forefront of deposit mobilization. We have 60% of our branches. When you look at the branch distribution of 6,300 branches, there are various branches which are 0 to 5 bucket, 5 years bucket, 5 to 10 years bucket, 10 to 15 years, and greater than 15 years. If the 0 to 5 year bucket gives you X amount of liabilities per branch in a year, the 5 to 10 gives you 3X. The 10 to 15 gives you 10X. The greater than 15 gives you 25X. So we have 60% of our branches which are now less than 15 years or 10 years? 10 years. So as it matures, the ability to generate more liabilities is something that keeps happening, and that is a positive. 2, we're quite excited about this growth opportunity. So what are we going to do? We're going to be doing something very, very tough, but it's my key objective. It's a vision, it's a direction. We're going to be opening 1,500 to 2,000 branches a year because we don't want to miss this opportunity. So we're virtually going to be doubling our network, or near doubling our network, in 3 years' time. We've done 730 branches this year, which itself is the highest in our 27-year history during the COVID period. So we're going to take the tall order of saying that, look, I think if that is a goal, let us put our might behind, because today the team has excelled. They can turn around. We had a branch open in one of the remotest parts of the country called in Himachal. There's a Kelong district. Kelong, Spiti Valley in Kelong. It's a remote part of the country. To get your technology, to get your branch, we did it in 16 days. So if you want to, we can execute. So that's the kind of, target that we are giving to our teams, combined to ensure that we start to churn branches more. You may say that, look, in this age, how do you need branches? It's not. Our branches is a sales and service outfit. And I will explain to you, India is still different demography than anyone else. It's going to be digital. you will have two sections. You will have the unassisted sections where customers can come in and do their transactions, do their products, buy on their own, or we can have an assisted section. It's going to be digital, but we will have the differentiation between a digital world and HDFC Bank is that we will be having an engagement. We will have with a human factor, there will be an empathy factor out here. You know, the Gen Z may be, you know, on mobiles, they don't want to meet anyone, they want to be in their own room, they don't want to even talk to the parents, they want to do their own stuff, they want to do everything on their own. It's reality. But as they mature, as they move from this Gen Z to the 30s, to the 40s, you know, their lifestyle changes, their lifestyle requirements will take a change. They will need to be engaged. And that is the differentiation that banks, large banks like us will bring to the table. Different from a fintech. Ultimately, people want to be respected. You give respect, you get respect. Newton's third law of motion. Every action has an equal and opposite reaction. So the moment you give respect, they are not asking for anything different or difficult. It's just saying that give respect in terms of speed of reaction, and you get 2 times over the move. Our objective is to move the primary banking. Selling a product is just not the main point. The annuity and valuations and whatever your value, whatever models you have is how my annuity comes. And annuity comes in when you move the primary banking to us. So the cross-sell, when we say that it's going to build balances, that is the beauty. It's not the 3-year or a 5-year loan that's going to give me earnings. No. It's the kind of the banking relationship that is going to be there for a perpetual period. That is where the valuations come from. And that is exactly what we want. We are not perfect, but this is what we have put in our rails, whether it is distribution, whether it's multiple other, we have an alternative banking channel, which is going to be an alternate to capture India, etc. See, when you look at the India pyramid, you have villages, you have blocks, you have districts, you have states, and you have the country. We have 6,300 branches. We are in 3,000 towns. We'll be double in about 3 years' time. But we still have the average distance in a branch just about 5 to 7 kilometers. It's 7 kilometers. It'll come down to maybe 4 to 5 kilometers in 3 years' time. But that's still a large distance. Just imagine, visualize you and I walking or going 5 kilometers to do a banking. We need to own the catchment. We need to have a higher density, and that's reality. And we are not looking at big branches. We are looking at small digital banking units with a personal banker who will be, or a relationship manager who will be able to engage with the customers. So what are we trying to do to fix the gap? In the meantime, we're going to have an alternative. We have now almost about 15,000 BCs, and we have a lot of partnerships with India Post, Airtel Payment Bank, Storking, Manipal, which will all come together now. We are now in the final stages of identifying all this. So we will be expanding. So it's a kind of an octopus kind of a structure. The branch out here, and you will have various BCs who will be digitally distributing our products. And to take care of the engagement, all our branches, as I said, will have an assisted personal bank relationship where they can keep on engaging with the customers. But as you know, we experimented this 3 years ago. We now have a full-fledged, which is going to be increasing our virtual relationship management program. Thanks to COVID, people, you and I, have started to engage virtually far more efficiently than in person. We are okay. I mean, prior to COVID, we always would think, hey, why a video call? I mean, I don't like videos, etc. I mean, we never engage. Today, we meet investors virtually now. It's very efficient. But of course, the joy of meeting in person is different. So engagement is a way of giving respect to the customer. And that is the thing. 50% of our customers at any point in time will have the engagement model, which means that our objective is to move the primary banking. So combination of acquisition, combination of spreading the acquisition through the alternate banking channels, combination of acquisition which you will start to see when the technology team will unveil what they're planning to launch between June and September. That's going to be a game changer, and I'm not even factoring that in, because your customer acquisition, which is 10 million today per annum, will rise. Apart from our own physical distribution, the technology platform, I don't want to even hazard a guess, that should be, I was quite excited with reading what Yono has done. It's a remarkable feat, and if we believe we can also do this or even better. I think if the large bank like an SBI can do that, why should we not be able to do that? And that is what you will see this when we unveil some of our digital products that's going to be coming out, whether it's June, September. I don't want to push anybody. I don't want to, create another crisis. Whenever they're ready, whenever they're tested as within the RBI parameters, let them launch. But when they launch, I think it'll be it will surprise the world at large. That's going to be positive. And to overlay on that is a relationship management. So I think we are on a roll. We have a massive opportunity. The durability of the organization to continue to power and extend banking to different parts of Bharat and India, to the various, look at the segment. We're just 70 million today. We may be 100 million in 3 years' time or slightly more. Their segment itself is 500 million opportunity. And I'm not even taking how, when you look at the 1.5 billion population, it's the first part. The second part, which is another 500 million, is moving with the per capita increasing. So you will see migrations happening. The runway is very large even there. I'm not even talking about the second segment where we will be participating through our subsidiaries or on our own in future. I'm not even taking that into account. So this is going to be a 50 to 100 year durable organization where we have seen a certain amount of consistent growth. We will continue to see similar kinds of growth, if not better, is what I believe. And it's all about our execution now. So we are quite excited about this. So I will pause out here. I think you will probably see the management heft, the kind of depth that we have. Each one of them are excellent leaders, par excellence than anyone else in the industry. You will enjoy their presentations. As I said, it's a great leadership team. You will see the might of this organization, and I will pause out here for any questions. Thank you.
Hey, hi, Shashi. Thanks.
Hi.
Just wanted to get a context of 1 plus 1 becoming more than 2 post the merger, right? So in some of the numbers that you presented, you said that so 2% of your customers have mortgage from HDFC Limited, whereas 5% have mortgages in total. So basically the penetration is only 40% of guys who want mortgages bank with you and have taken from a group company. And so you also mentioned that 6% of your customers have auto loans from you. So if you can give some data in terms of how many customers may have auto loans from someone else. So just to get context of to what extent this 40% penetration can go up. Also, in terms of not all your branches distribute mortgage products because HDFC does not have a footprint there, right? So again, going back to say auto loans or some well-penetrated product. So the branches which distribute both mortgages and PV loans versus branches which distribute only PV loans and don't do mortgages. So the first cohort will account for what percentage of your auto loan book? So
Sure.
That's the context.
Yeah, sorry.
Sorry.
No, go ahead.
Okay, thanks. So one more question in terms of say, suppose on 31st of March 22, right, if you look at your numbers plus HDFC Limited's numbers, so at what level of SLR would the combined entity be, assuming that both of them are treated as one entity and are subject to the same reserve requirements? And what will be the LCR number? Just to get a context of, because to get a context of, how much is already achieved and how much is yet to be achieved.
So let me answer the last one first, because that's easy, and that's something that he had put it up on the slide. Our estimates is that when we do merge, as he says out, we need about 85,000 crores between SLR and CRR. Between the two organizations, we'd be more or less near that. So incremental effort, I know the effective date is 18 months away. So there are a lot of things that we can do. Like, for example, the reality is we've used the 31st March to a part of a quasi high quality liquid assets. If you see the March numbers of our own HDFC Bank growth rate on the corporate side, there is a massive run up in terms of opportunities. So we have grown rather quickly in the last quarter, which utilized some of the high quality liquid assets, and we put it in the corporate assets, which is in the 30, 60, 90-day bucket. So it's as good as, we said that why not get the 25 basis points as a short-term opportunity. It's all right to get down, but that'll come back. So when you look at the requirement as of March, and when you extrapolate the growth and we try and see what it will be, say in September of 23, which is probably the expected date of the, where the merger approvals could come, we believe that the incremental effort could be either very negligible or even zero. So this particular 85,000 as against, because he's now currently having a 40 to 50,000 crores. I do not know what is the 31st March numbers of government securities at HDFC Limited, but I vividly remember it somewhere around the 40 to 50,000 crores. We ourselves have, as I mentioned, then an unsecured need. So let's look at unsecured loans. All our 6,300 branches, which is our marquee product, sells unsecured loans across, and all our 6,000 branches sells it, which is not the case when it comes to about home loans. So we have to now really engineer, there are a lot of things. Now that the two leadership teams have come together, so the ideologies are now converged, so we will now look at what is necessary to change without compromising on the risk part of it, to see how to ensure that all the 6,300 branches start to sell home loans. And you may wonder, what are these? Simple things. Normally, HDFC Limited likes to give a home loan if the property collateral is in probably the metropolitan location or some of the top urban centers like Chandigarh, Jaipur, etc., etc. Urban saleable property. When it comes to the semi-urban and rural, which is good, the tier 3 to tier 6 towns, say a Palanpur, say a Haldwani, say a Roorkee, say a Rishikesh, Dharamshala, McLeod. McLeod, leave it, it's a small hill town. That's okay, leave that. There could be complications in terms of title for McLeod, or whether even in, which is a place, Mussoorie, etc. Leave aside all that. I'm saying that they may be restricting themselves only to town limits. See, normally these towns, as you go to tier 3 to tier 6, the radius is very small. You and I, or the segment that we are talking about, we may be the upper middle income, but the middle income also would like to stay on the outskirts, outside the town limits, because you have good quality life. They don't want to be in the hustle bustle of that small town. It's a small town, they won't be there. So these are some of the changes that we have to do. And you may say that, is it safe? Absolutely. Digital India has done wonders. Today, when you travel 50 kilometers away from Palanpur, you will be able to know whether a particular plot is registered mortgage or not digitally. You get onto the CSE e-governance website, you check out, you will know whether this particular property is mortgaged to a bank or not. That's the kind of visibility that is there, and that is all that we need. You know, we talk about hypothecation here. You have it in the Tehsildar's records or registered mortgage, which is digitized. I mean, some states have to do it, but even if it's not there, it's there in the Tehsildar's records. So it's all about how you are able to change these things so that I'm able to open up. So a branch in a Roorkee can start to say, why not here? I mean, maybe doing that. Roorkee is given. I'm talking about the smaller towns, Palanpur or Bunter or you name it. So these are some of the changes that will happen so that I can ramp this up into 6,300 branches. The third part of it is on you have a 2% and you have lost 5%. What about auto loans? We do have a fair amount of people who take loans from outside. You may wonder why. The reality is that we are the intense competition. You know, you have sometimes the DSAs faster than some of us altogether. What are we trying to do? We are trying to ensure that how we can try using our AI/ML platform, try and see, using analytics to see when that particular person has that thought that I need a home loan or I need to have a car or I need to renovate my home. That moment of truth is something that we need to prepone, which means that we need to know that. We need to get into the minds of the customer. So that's where our digital heft will help, our technology heft. We are doing a lot on data. We probably have done a fair amount in analytics. We are very advanced, but I think we can do better. I'm not too sure whether these are presentations which are there today, but there are a lot of things that are going on in the background to be able to get to know. So we call it the need-based selling, wherein I'm able to try and see whether I can contact the customer when he has a thought and not as a post facto. So we still have today, even with the kind of growth, even though we are the largest retail asset bank in the country today, ex-mortgages, we still have a fair amount of our customers moving out. It could be credit reasons. We are not comfortable with the credit. Leave aside that. They are not approved. I'm talking about even where they are approved. We do have. Why? It's possible we have not been able to reach out to them faster than all the associates in the system. And mind you, if you think that the competition is not intense, it has always been intense. It's a myth that we never had intense competition. Competition was intense, it continues to be intense, it will be even more intense. So we have to continue our story, and we have demonstrated that. I mean, you look at our, despite the intensity, look at the kind of gains that we have had. If you take a 5-year horizon, a 3-year horizon, a 2-year horizon, a 1-year horizon, the gains that we've had, whether it's on assets or liabilities, with all this intensity, is such that it's greater or much more than the combined peer banks put together. So we are in an environment where we will continue to see intensity of competition, but we will continue to power despite that. So it's a great question that what do we have to do? It's again an execution capability, the way we leverage on our technology, the way we leverage on data, the way we leverage on analytics, the way we leverage on AI/ML layer to power all this, to be able to give us information way ahead of time to say that, hey, go and meet the customer much before he is committed or he's pregnant to take it from another institution, etc. This is one of our biggest objectives. This is exactly what our focus area is. But it's a reality today that we do lose. It's not. But the opportunity for us, I mean, today when you look at our what we have, you'll be amazed to know the potential. Today, we know so much about our customers that we have pre-approved a massive amount of customers with offers where we can give a 10-second loan. You know, it's equivalent to 5 times our current retail book. I think it's almost about 32 lakh crore. I mean, that is the kind, here it is, yeah. You know, look at the kind of offers on the retail side. 77 million pre-approved offers, which aggregates to 32 lakh crore. I mean, virtually 5 to 6 times the retail book that we have. That's the potential. So just imagine if we refine our methodologies, our analytics, the ability to go and tap into the customer when he or she needs it, when he's thinking about it, that will be the ASIC. And that is what our job is. And that is exactly what we are trying to do. You know, people look at platforms, which is equally important, but the amount of work that we're doing in the background to be able to come to this kind of a precision, to this kind of a advantage is something that is going to take us to the new level. I'm not even hazarding a guess as to how, but that's going to be one of our key objectives.
Thanks, Shashi.
Yeah.
Hello, good morning. So just the first question that, given the fact that as per the house view, the macro looks good and everything else that we have talked about, somehow the balance sheet doubling in 5 years, which comes to slightly less than 15% on CAGR basis. So why that? If you peel the onion on that, what's the thought behind that number? Because
that's the most conservative thought I felt. Because see, one of the most asked questions by your fraternity and by your fraternity across outside of India is that on such a large scale will be able to grow. So if you look at our track record as it is here, we have been virtually doing 2.4 times the balance sheet, which is almost equivalent to a much faster growth rate, an 18 to 20% CAGR, whether you take 2012 to 2017 or 2017 to 2022. So we have that potential. So what we're trying to say is, even with a very conservative estimate, the power of the bank to continue to grow even on this kind of a scale is possible. Eminently possible, because we have demonstrated a much faster track record in the past. I mean, is it there? I mean, in terms of the growth rates, 2.4 to 2.5 times is there. No, not this one, the other one where we have grown.
So let me just ask the other way. So barring the caveats around the war escalating, the COVID coming in, this number looks like probably if I use in the back.
See, the point is, this is just a kind of, to tell you, I mean, you may say it's 15%, okay? The point is, at a larger scale, to do at 15 to 20% is a massive effort, because what we're going to be adding is going to be many banks. So you need to appreciate that it's not just pure Excel spreadsheet that you're extrapolating. It's a lot of effort at the ground level, as I said. You have to generate liabilities, you have to ensure that you maintain your credit quality, etc. So all we wanted to convey that is that at a very modest growth rate at such a high level, just imagine the scale that this organization will generate every 5 years. But does it mean that we can do faster? Absolutely. I don't want to commit to that, but I'm just trying to showcase that if we can do at these compounded growth rates, doubling the balance sheet every 5 years or creating a new HDFC bank every 5 years, and you try and do it basis your historical trend, it's going to be much faster.
Great. And just one last question, and this around the mortgage, couple of things that you shared. So if, let's say, the ROA is going to go from 2 to 3%, but the ROE number is 20%, so that's a 6x leverage or odd.
See, the reason for that is, good question. When we are adequately capitalized today, the reason for that is our growth rates ever since we raised capital in July 2018 was actually less than the sustainable growth rate. We have not consumed capital. We have actually added capital. We've added about 200 plus basis points of capital ratio from July of 2018 instead of consuming 60 to 70 basis points of capital because of various factors. The economy was sliding even before COVID struck us, and COVID itself sort of was a kind of a tumultuous event. HDFC Limited also has a larger capital ratio. They have been monetizing their assets and they have a large capital base. The good part is we don't need probably capital all the way to 2030. I mean, that's my rough estimate. Srini would probably have a better pulse of that. So here I'm talking about, you're right, at a 3% ROE, one should have a higher percent, but that's upon the leverage. And the leverage will happen how you consume capital. So because you have excess capital, you will have that slightly lower because you will, even if you now grow, you will be consuming 60, 70 basis points. The leverage, which is roughly about 9 times today, will take time to go to a 10 to 11, etc. So it's all about how I consume capital, and therefore, my point is, if you exclude the excess that is there, you are a 20+% ROE company.
So I'll just cede the floor of one more. Sorry for just holding it back, but if I assume there are already mortgage-heavy peers who do a lot of mortgage inside a banking structure, and if there is anything differentiated, I would love to know. But if I plug in the same math in their ROAs, which are doing this kind of a number with 10 times leverage and actually generating 20% ROE in a mortgage book, the aggregate ROAs are not supporting that. So why is it?
No, you have understood.
Yeah, I don't know about the others, but you do have to look at the cost to income of the mortgage business. Anybody who's got very heavy mortgages, what is their cost to income? But cost to income of HDFC Limited, which has got quite heavy mortgage, you can see what that cost to income is. It is all about how efficiently you execute.
See, I think you probably have, I am not sure, but I guess this entire fraternity probably has been tracking HDFC Limited for almost 40, 42 years. Let's face it, there is a certain amount of excellence that they have done. Cost of repetition, the spreads are low in this mortgage business in India because it's been an intense competition. But I think he's the only company, not just in India, but globally, wherein they've managed the cost of operations at this kind of levels of less than 10%. And the asset quality to be probably far, far superior than anyone else. Whilst you know this, you have probably, it's visible for you from your side when you talk to them. It's visible from our side as well. Because we are a mirror of what we have our sales force, we have similar, probably higher cost structure. We still have a 2+% ROE on the book that we buy from HDFC Limited. So it is, I know this was a kind of a surprise to all of you, saying that is it a 2+%? It is a 2+% ROA. That is why it's in a very attractive franchise. That is why it is impossible not to ignore this. That is why it's stupid on our part to miss out an opportunity to merge. It does not make sense even to build your own book because the quality of franchise that I'll be taking over. Also, there's a brand impact. Because ultimately, whether you like it or not, because of the convergence of the regulations, at some point in time, being wholesale funded, he will have to merge with some bank. It may not be ours. If it's not HDFC Bank, we will lose the brand. We will not be an HDFC Bank anymore. It's a very huge consideration. And that is the reason why it made sense for us to go and bat on the front foot on this particular aspect. Yeah.
Am I audible, right? Yeah. Yeah, thanks, sir. Just taking up 2 points that was spoken about already. One is the aggressive branch addition plan that you were talking about, right? I'm assuming a large part of it, as you highlighted, some examples are going to be outside the urban locations in remote places. And there, if you're adding a branch, you will not just source deposits, you'll be lending as well, which means you have to set up credit, you have to set up collections, everything. So when you're talking about 1,500 to 2,000 branch additions in a year, what does that translate into employee count? How many employees are going to be?
No, good question. So we are not going to be apologetic. We're going to use this opportunity to invest in technology, invest in distribution, invest in people. But X mortgages, leave aside this particular event of a merger. Even otherwise, while you may see, look, the cost to earnings prior to COVID, we had brought it down from 49% to a 39%. During COVID, retail, we clamped down retail because there was so much of uncertainty. So therefore, retail is a high cost, a lot of variable cost which is linked to disbursements. So therefore, you started to see the cost to earnings go down to a 36% odd. Now, when you're coming back out of COVID, you will see this go back to a 38, 39% with additional investment in branches, etc. So I'm happy even if the cost to earnings deteriorates to a 40%, it's all right. But the reality is that the operating leverage will start to kick in because ultimately it's a scale game, it's a revenue game. So the jaws will widen and you will start to see in 3 to 5 years' time the cost to earnings coming back X mortgages, X merger into the mid-20s, in mid-30s, which means that if on the merger, hypothetically and pro forma basis, we get a cost to earnings of 32%, they're 9% and our 38, 39%, we will be less than 30% in 3 to 5 years' time after the merger. So that's the kind of an operating leverage we are going to see. So we will continue the investments. Our jaws will widen and you will start to see efficiencies coming in. So that's given. Sure. That is something we'll be on track and that is our key focus area.
Sure. So I don't think, given the scale at which you're talking about additions, any one of us would be, expecting a reduction in cost to income ratio. So the point was basically to understand when you do lending in these remote locations where you're opening branches, what type of physical manpower scale that would require?
So even that will also go. You will see increase in manpower because ultimately, with every addition in branch, you will see us start to have roughly about 6 to 8 or 8 to 10 people per branch addition. You have to estimate that.
Sure.
But these are all the army, largely whether it's on the acquisition side, whether it's on the credit side, you will need manpower, or collection side, you will need it. But at the same time, as I said, the pace at which our operating expenses will grow will be slower than your revenue growth.
Sure. The second bit is on the mortgage, the chart that's being talked about, the 2% and the 5%. So the 7% of your customer base having mortgage loans, if you add the 2 and 5 up.
Yeah.
If you compare it with other banks, what does the number look like?
I wouldn't know that. I mean, this is the first time.
So if you look at the entire industry, that has about some...
No, but see, look at this. My point is, we are talking about an industry which is going to be on an upswing. We're talking about a sector which is so lowly penetrated, which is going to see a huge change. We're talking about growth, not just coming in from the top 100 towns, but we're going to see in tier 3 to tier 6 cities where we are well positioned. Today, we are missing out that opportunity. Today, we are not even sweating that opportunity which is there. So the point is, apart from having our own customer base in urban and metropolitan, which we have not proactively, done a need-based selling on this particular emotional product, just imagine the opportunity when we go down to the tier 3 to tier 4.
Right.
So even though the penetration, I mean, it is willy-nilly. I mean, it is evident when you have only 11% of GDP on this, the fact that it's a runway that is there for us It's a runway that will be there for other institutions as well. But here is an opportunity where, as I mentioned, we have not really sweated our liability machinery to the fullest. As I mentioned, in FY21, we added incrementally 100,000 plus crores of assets. We just had enough liabilities to fund that kind of a growth, and CASA grew at about 24-25%. So the balance was the granular, the time deposits. In FY22, we added 200,000 plus crores of assets. We funded that with granular liabilities, with CASA growing at 24.5%, but time deposits growing only by about 7%, which means that we said enough, just enough to do that. Now, when you look at the 70 million customer base, only 14% of our customers have term deposits. Now, when you take a poll in this room, we will have, all of us will have some time deposit in the bank, in some bank with us, in our portfolio. So, willy-nilly, why is it that only 14% of our customers have? Because we have not sort of kept it as a key initiative. We've said that, look, we have a lot of other things to do. This is necessary only to the extent that we need. So the moment you make this as a part of a scorecard at the front end, you can move the needle. So when you talk about liabilities, that's one of our strategy. Every 1% change, a 14% to a 15% change gives you a $6 to $7 billion or $6 billion of incremental liabilities. So we need to have a vision over a 3-year period to move from a 14 to a 16 to a 18 to a 20 to a 25. I mean, why not? Because we have never focused on this. The moment you start to focus, like all other aspects, we should this is a part of our execution. This is our responsibility, apart from the ramping up of a distribution, to see that our liability growth. And you will start to see, obviously you need to be comfortable. So even before the merger, as we see probably, I'm not talking about this current quarter, maybe next quarter onwards, you will start our liability machinery growing faster than our assets. So which means that we will have,
One other thing, maybe if that's helpful. On day one of the merger, it is not envisaged that the funding side of HDFC Limited is replaced by the deposits of HDFC Bank. It is not envisaged like that. The contractual liabilities of HDFC Limited will run through its course. And as it runs through its course over the next 3-5 years after the effective date, it will get replaced by the bank deposits.
Shashi, over here. Hi. Just wanted to ask one question. You said the entire thesis is on extending the relationship engagement. In the existing customer, can you give a rough thesis that what the customer relationship value has gone up to? And after this merger, where your internal targets you want to take it to?
You have any metrics on that? I may not have at this juncture. It's not that we don't look at it, we do look at it, but offhand it's not there. But broadly, because we acquire a large portion of our customers every year, and if you see the last 5 years, the vintage of our customer acquisition has been very large. Out of the 70 million customers, a large portion would have come in over the last 5 years. We were maybe 5 years ago 1.5 million, then a 3 million, then a 6 million, then an 8 million, and 10 million. So when you aggregate that, the 70 million that we're talking about is all recently acquired. So when you stratify the 70 million into the top end, which is the private banking, when you talk about the preferred, where you have an RM, the relationship management, when you talk about the virtual relationship, which is one level notch below, and then when you talk about the mass affluent, which is non-managed, the product penetration is different. The first one will have, I'm talking about revenue products, we're not talking about engagement products like a net banking or a mobile banking, is the highest for the private banking, which will range between a 6 to 8. You go to the next level, which is your imperial relationship, etc. You will come to 4 to 6. You come down to the next level, which is the virtual relationship management program. That will be a 2 to 3. And the last one will have just a 1 to a 1.5, which is the mass affluent. So weighted average, because a large part of it is in the non-managed part of it, you will have a weighted average product penetration not more than 2 to 3. That is the weighted average, or maybe a 1.8 to a 2.2 is where it will be there. That's reality. That also sort of suggests, and that also sort of signifies the runway we have. See, ultimately, our job is to engage with customers and serve the customers. The moment you start to focus, you start to penetrate. My point is, our 27 years of whatever we are at this juncture is a resultant of our institutionalized sales process and engagement process that we've had. We probably will be fine-tuning it more and more with better tools and better technology platforms that you will start to see when our teams start to present, in terms of how we can cut down processes, how they can be a self-service, or how we can run this on their own. So we believe that without any dramatic change to what it is, I think the runway that we have in terms of just penetrating more, because ultimately our only job, our main job, which I say internally and also externally, is moving the primary banking to us. The value comes in not from an acquisition, not from putting a product. Value comes in when I move the primary banking where you are the primary bank. It doesn't mean 100% of the cash flows or his transactions have. At least you should be the market leader with a 30 to 40% share, which is the kind of principle we have, whether it's a corporate banking, whether it's an MSME. Of course, MSME is different. From a risk perspective, you ask our chief credit officer, he will say that I would like to have 80 to 100% flows through me. So that's a different model altogether, where we have a self-funding ratio, which is almost about nearing 100%. We operate between the 90 to 100%, and that's a model, embedded model. So each of the segments that we're talking about, we have an engagement philosophy, engagement process, engagement thought process, various levels, because obviously it's not feasible and possible to have 70 million, but we are going to do the impossible, that over a 5-year period, we will have a large part of our customers to be engaged either by the physical RMs and the personal bankers or through virtual relationship management programs. Of course, I'm not even talking about the engagement through the digital marketing. That is something that is probably, it may be small today, but it's probably advanced better than what anyone else has globally, and it will only evolve with better analytics as well.
Shashi, just to follow up on this, can we expect the run rate which you maintained, that doubling the balance sheet in 5 years, the same customer acquisition which you told value, that will also run in the same manner of a 15%? And just on top of that, the private banking, the top notch, is that segment getting matured in terms of growth? Because the mass affluent can go to 2 to 4, but private banking, that 6 can go to 10 is the...
Yeah. So let me answer this in 2 parts. Number one is, when we're talking about a certain amount of a growth, we're not compromising on the customer segmentation itself. Our customer segmentation, since you're talking about retail, is the middle and the upper middle income segment group. We have a large segment waiting to be tapped. I mean, whether it is already banking with, say, the existing banking system, which is one of our feeders, or it's new to credit, new to banking system as well. So we're not compromising on that. So when we're not compromising, we have a certain normal distribution curve, which is currently there, which when we are projecting a certain growth rates, which is very conservative, it also factors in this kind of a penetration levels even across. Since you specifically mentioned about private banking, which you can probably hear Rakesh and team during the day. Today, we are probably present in a smaller set of locations. The vision for the private banking is that if you are going to be in 3,000 centers, our first milestone is we would like to be in 1,000 centers. Now, we are not I don't think we are in the ultra high net worth kind of category, which is Julius Bayers, or the IFLs, etc., or the Motilal Oswals. No. We are probably one notch below, but there's a massive amount of opportunity. You'll be amazed to know that, just think about it, intuitively. You go to a Roorkee, you go to Dharamshala, you will have 500,000 wealthy people, or a Palanpur. You have 500,000 sight unseen. People who are there, who are living in Palanpur, who are wealthy enough to be a private banking customer. So you'll be surprised to know that this is going to be a key strategy which will ensure that we will be the largest private banking segment in the country today after we reach 1,000 or 2,000 or 3,000. I have probably, Rakesh will sort of explain that even better in his presentations, but that's the opportunity. So we are not going to be trying to do things which we are not an expert. We are not the ultra high net worth as of now, unless Rakesh, wherever he is, yes, unless he has that thought process, which he will unveil it in his course of the presentation.
Yeah, hi.
Yeah, hi. Just in the interest of time, we'll go towards the center of the room, if you don't mind, just so we can maximize the ground that we can cover.
Yeah, hi.
Yeah, hi. Just one continuation of the previous question. When you talk about a liability and a customer acquisition and adding the number of customer, one of the key aspect of customer acquisition is somebody who opens an account for the first time, or a minor who turns major and come to your bank for the first time.
Yeah.
The experience which they get is not very healthy, not exciting, and this is a personal experience I did in last 3 months. And the kid is so annoying that you have an emotional connect with HDFC. Dad, I don't have that. I care a shit and I'll go to next bank.
I agree.
So what are you trying to do for that, and want to retain him and to become your top-notch customer?
Point taken. Absolutely.
If you can share something about that.
No, you're hit the right point. One of the priorities for me, see, as I said, we all have, the leadership team has inherited a platform and an engine which is amazing. Kudos to the man who built this, Mr. Puri, and his founding team over 27 years. It's a great engine. But one of the things that we need to focus, and that's why it's one of my priorities, is the customer service first culture. Now, it's a combination of how you interact with the customer, the speed of reaction as frontline people, or the touch points that you are seeing, and two, is even from a process perspective. It is a fact that we probably have not even re-examined some of the processes which are very, very antiquated, and it's a flaw. It's a flaw that we need to correct. So we have embarked on, especially called the WOW journeys, walk in, walk out. Walk out working. So it is what we're trying to do is the example, a minor to a major, or change of address, or change of mobile number. These are all fundamental instructions. Of course, it is to be in compliance with the regulations, but these are all can be done with a click of a button. So I'm not too sure whether the tech teams will do it, but behind, maybe if Arvind is presenting today, one of his most focused areas, along with our quality initiative team, is to see how many can be migrated on a service mode. When I say self-service mode, means where the customer can do it, or when you walk in, whether it can be on an assisted mode. But it has to be one click. It cannot be that it takes the kind of pain that you went through in converting from a minor to a major. It is a point. Today, we do have complaints. It is not, it may be, for the kind of balance sheet in this, it may be small, but it is not good. We have brought it down by 20-30%, but it's not enough. So the leadership team, it's one of the biggest priorities apart from employee culture is a service first culture, wherein we are focusing on to see how we can get down, to the basic respect to the customer. It's a kind of a wave that we are going at it. We are not perfect. We are not still there. And the second one is, how do we convert our processes to be a self-service, one-click experience? So this is, as I said, when we are talking about key objectives, which is under my radar and in my responsibility, these are some of the things that we are working on, and this is something that may not happen overnight, but it is going down on a wave. So we are focusing on this. We have a lot to do. We are not there. I think if I need to have sustainability of growth into the future, that is why this is one of our priorities. You will start to see, in fact, probably, maybe we can unveil it in a public forum, in a public document, as to how many such transactions, instructions that a customer would like to do, how much of this is moving towards a one-click experience. Maybe we will start to put that out.
Just continuation. Even a re-KYC.
I agree.
We see a lot of that on the social media, especially a non-individual account re-KYC. I think the team even at a marquee branches doesn't know the number of documents required.
So
the customer needs to keep walking.
You're right.
But he gets very frustrated, and you lose a very important account from your bank.
No.
Somebody else is not something which we as an investor would love to see.
No, I agree with you. These are, especially on the current accounts or the non-individual accounts that you're talking about, it is a pain. It is a pain area which has been identified, and Rakesh is here as head of the overall product team. It is their responsibility, along with a cohort of people, to ensure that we digitize all these things. We re-examine the compliance requirements. We re-examine the documentation requirements. There is a lot of work to be done on this. Yes, so we're saying that whatever we are talking about is with all these inadequacies and inefficiencies baked in. Just imagine, by changing all this, you are only going to make it even better. But these are priorities that we have recognized, we acknowledge. We have a lot of work to do. It is my responsibility on this one.
Yeah.
Hi, Shashi.
Sorry, just in the interest of time, if you can restrict yourself to just one question, we'll take 3 or 4 hands at best. Yeah. Thanks.
Yeah. Hi, Shashi. Just 2 questions. One is on the from now till merger, when you build your aggression on your deposit accretion, how do you see the loan to deposit ratios moving, and how do you see the margins moving during that time? And the second part is, post the merger, when you are just a couple of points lower than the SBI in terms of the overall industry market share, would your philosophy on the wholesale loan change from a more working capital and balance sheet funding to a more project financing kind of structures?
So, good questions. The credit deposit ratio should start to change. I mean, we are probably in the mid-80s at the moment. Is that right? Yeah. So it has to come down as we start to demonstrate to ourselves, forget about the world at large, that our liability machinery can absorb this growth. I wouldn't say overnight, but it should have a glide path to come down to from an 85 to an 80 to a 75, etc. So that's part one. It's not an easy, it's an execution on our part. I think we still have 18 months, and you will start to see that. What will it have an impact? Absolutely. Whilst normally if you do deploy and put it in high quality liquid assets, it's still a positive 2% ROA. It's not a problem at all. But yes, the spreads will be smaller. So you will have a margin impact anywhere between 15-20 basis points, depending on the size of the excesses that we have, because these are things that we have been doing it right from October 17, so it's already embedded. For a long period of time, we've been carrying a drag of 15 to 20 basis points. I don't see any reason why we will not be carrying this drag even into the future. It's all right. It's part of the business model now. What is it? But the ROA will be plus 2% because, you want to explain that why is it 2% ROA?
Well, no, the cost of deposits, when you compare the cost of deposits to the yield that you get on an HQLA, the margin is quite enough that gives you the 2+% ROA. So it's not ROA decretive. And the second thing is that from an ROE point of view, also it is actually accretive to ROE because securities typically don't have capital. You will have leverage capital, not risk-weighted capital. So it is so keeping additional reserves or higher liquidity is actually not a bad thing. It's actually a good thing.
If you could just
Sorry, what was the third question? Yeah. See, I think whilst we are one of the largest working capital banks in the country today, there is a little bit of a myth saying that we are not into term finance or project finance or infrastructure lending. I think over the last 10 years, I think the bank has great expertise in assessing infrastructure projects, term finance, and you can probably get to hear about it. You can sort of ask Nirav and Rakesh and Jimmy in the next presentation, which you'll be surprised. Today, they will tell you that, over the last 10 years, I think we've become one of the second largest loan and debt syndicator in that particular part of the business, which means that we have been participating in term finance, etc. We may have probably started off as only in the brownfield projects, but now I'm sure, we are doing a lot of greenfield projects in sectors and in areas that we are extremely comfortable also. I think with one of the advantages which I did not mention with the merger will do is to give us the runway for our ability to build for a larger proportion without compromising on credit on the term finance as well. So it's just going to add to that advantage because we have that ability to assess credit much better than what we did maybe 15 years ago. So I think we're not going to sort of go back to an era where we're going to be doling out like biscuits. It's obviously, that's not our philosophy. Our credit architecture is independent, so we're going to do only what makes economic sense. And by the way, the businesses, whether it's the investment banking team or the business team or the corporate side, are all mature enough, and they themselves are, first levels of filters even otherwise. So it's an opportunity, and we will be having that advantage to bat on the front foot in terms of bidding for projects and term finance, because we'll have a larger amount of capital and we'll have, so the concentration risk today will be much lower as the capital comes in.
We'll take Ashwini and then I'll come to you definitely. Yeah, Ashwini, just one question if you don't mind.
So just on clarification, you said you'll double the balance sheet in the next 5 years. Is it post the merger or from the current date?
It doesn't matter, whichever way.
Look, anyway we're doing at 2.4 times every 4-5 years.
No,
so.
the equation changes substantially because if
I know. See, the point is, it's, as I said, again, at the cost of repetition, growth is not an issue. Growth is going to be pouring out of the years. It's how we execute in terms of funding that growth is important. That is the reason why, it's theoretically possible that I can grow faster, but would we want to do that? Because there are two things, and this is 27 years of rich experience, not just for me, but for the leadership team out here, which you will mention. when you start to grow faster than what you can, you get a bit uneasy. If it's possible, we will do it, but we wouldn't want to do that. We would want to restrict only to the extent that our stomach, sometimes, we've all been taught, and that is one of the greatest USPs of HDFC Bank is sometimes the stomach will say, slow down, etc. Even you look at even the COVID period, it may be hindsight now, but when March happened, when COVID struck, none of us knew what was happening. But look at the intuition of the entire organization. Just clamped it. They just said, enough, we can grow, but we don't want to grow. Because, this is the beauty about the architecture that we're talking about. I can grow faster, we can grow faster, but do we want to grow? No, we will try and see multiple aspects, the macro, the early indicators, B, the funding. So there are a lot of, points that we need to keep in mind when we are trying to talk about. Theoretically possible, but do you want to really stretch beyond your limits? I don't think we will do that. Yes, when I'm talking about it's conservative because our track record says that we have done faster. Maybe that'll happen. Maybe that'll happen even more because if it is a secure product like a mortgage and that is driving growth, why not? It's a great secure product with a fantastic quality, asset quality. Maybe. But I don't want to push myself and give something to you and then you will keep us, the very fact that I'm saying that we'll double itself is a big departure from our normal, we don't have a guidance. So I think we should be happy with what I've said thus far. Anything beyond is a bonus.
Saish, if you don't mind, I'll just take one question and then come back to you. Yeah, if you could just, I know you don't have a mic, but I can probably paraphrase. Yeah.
Sir, just probably 50% of your time is now focused on the merger and the management bandwidth. So what is the thought process or what's the growth that you are looking for the non-mortgage retail portfolio during the transition period and the post-merger? This is more relevant also for the post-merger because the food soldier will have one more product to sell to a customer who don't have more than 5 minutes to speak for him. So whether he would be selling a mortgage, a vehicle, or credit card, or so the bouquet is increasing and probably he will be getting more confused. So there are two questions.
So two parts to it. Number one is, unlike a bank-to-bank merger, which we have done in the past in 2000, with Times Bank, 2008 with Centurion Bank, this is going to be a less intensive, it's going to occupy lesser bandwidth. And I'll tell you the reason why. They have just 600 branches. We have 6,300 branches. All of them are quality branches. So I'm adding, as I said, we want to add 1,500 to 2,000 branches. So it's a straight, simple, akin. In fact, it's not there. When you really come down to the grassroots, it's not there. It's just about 6 or 7 branches which will have an overlap. But the quality is so good that we may want to keep it because of spaces. Even if it's out in Ahmedabad, I have an HDFC opposite and I have the HDFC main branch, opposite to each other. But why not? I have the home loan operations there, so it's good. So these are minimal overlap, so the integration of branches is going to be so easy for me. 2 is on people. 3,500 people, 1,41,000 people. It's no sweat. We are adding almost about 15 to 20,000 people per annum. The quality of people, when you look at HDFC, is fantastic. They will all they were all handling a monoline product. Now they will handle multiple products. So it's going to be upgrading their sales, upgrading the career, giving them a new career path and growth. So that's not an easy issue. And I've said this openly to the leadership team in HDFC Limited, we want to welcome all of them. We have seen what it is. Third aspect is on technology. See, unlike a bank where you have millions of transactions on a per millisecond basis, in an asset company, you have a loan to be booked, and you have the back end to set up for EMIs, etc. It's not a high intensity system. So all that is required. We have where I just consume the APIs into our system so that we can integrate the GL and the aspects of it and into our various relationship programs. Fortunately, that's an advantage now. Unlike in the past, you have a services-based architecture, which was not there many years ago. What was the last question? Yeah, so effectively, what I'm trying to say is, am I going to be spending too much time on or the leadership team is going to be spending time on the integration? No. We need a battery of compliance teams and the legal teams to do all that is required. We probably need the finance team. We probably need, others are going to be very peripheral. It's going to be a low intensity, low bandwidth integration. Last but not least on your question. Today, home loan is a part of our product portfolio. It's a part of the product offering. But we are not selling it because we don't have the tools and the enablers to help the frontline team to sell. That is the reason why we have such a low penetration or low set of branches doing it. The moment you start to converge, the moment you start to have your policies converge, open up to be able for the frontline team to sell, actually he will be delighted or he or she will be delighted. So it's a positive because when you look at it, it is the most easiest product because it's an emotional product. People would love to have a home loan, as against fishing for, whether you want a personal loan or a consumer durable or a card. So it is, I believe, is going to be going by, and you can check it when you go down and you interview the people at the ground level. You'll be surprised to see the joy that the frontline people will have when they say that I now have all the enabling tools to sell a home loan. That is the reason why we have not been able to do. Now, when you enable them, it's going to be a positive.
Just in the interest of time, I need to bring this to an end. We are at 1 p.m. if you don't mind. I know I've missed out a handful of people, but the sessions beyond lunch are going to give you a lot of those answers as well. So if you don't mind, we'll now disperse for lunch. I'm extremely sorry. Thanks.
Anyone who needs further questions, we are on call. We can be reached. I know some familiar faces, so happy to take calls, happy to sort of, talk to them even on a 10-15 minute basis even outside.
Yeah, we'll do small hurdles maybe.
Thank you so much.
Thank you.
What a pleasure to meet all of you. Thank you.